me be very direct with you right now. And I want you to understand that what I'm about to say is not a prediction. It is not a theory. And it is absolutely not the kind of soft financial commentary that gets passed around at dinner parties by people who have never actually built real wealth. On February 28th, 2022, something happened that was, in my estimation, the single most consequential financial event of the 21st century. And the overwhelming majority of ordinary investors completely missed it, were never told about it clearly, and are right now sitting on portfolios that are dangerously, embarrassingly misaligned with the new reality that event created. We are talking about a $29 trillion race, a sovereign arms race conducted not with missiles, but with gold bars being run by the most powerful central banks on this planet. And if you do not understand what is happening, why it is happening, and what it means for every dollar you currently hold, then you are not investing. You are simply waiting to get poorer. This video is going to fix that, but only if you have the discipline to pay attention. Now, before we go any further, I need you to do something that costs you absolutely nothing, but will be worth more to you than most of the financial advice you have paid for in your entire life. Hit that subscribe button right now. I am not asking, I am telling you the information in this channel, the data, the frameworks, the institutional grade intelligence that we break down in plain language. This is the kind of analysis that hedge funds pay analysts 6 figures a year to produce, and you are getting it for free. The only price is a single click. If you cannot commit to that, I genuinely question whether you have the discipline to build serious wealth, because wealth building starts with one very simple habit, and that is showing up consistently to learn. Subscribe now. Let us continue. I want to take you back to the morning of February 28th, 2022, because I need you to feel the weight of what happened that day. Not just understand it intellectually, but genuinely feel it in your chest, the way every finance minister and central bank governor on this planet felt it when the news broke. Russia, a sovereign nation with the world's 11th largest economy, woke up that morning and discovered that $300 billion of its foreign currency reserves, money it had accumulated deliberately and strategically over the course of 2 full decades, had been effectively neutralized, not seized in the traditional legal sense with court orders and due process, not gradually eroded through market forces, switched off, disabled, made functionally worthless through the coordinated action of Western governments who simply decided collectively and unilaterally that Russia no longer had the right to access assets it legally owned. Now, I want you to sit with that for a moment, because what that event revealed was not merely a geopolitical maneuver, it was the exposure of a fundamental and catastrophic flaw in the architecture of the global reserve currency system. Here is how dollar reserves actually work, because most people have a profoundly naive understanding of this mechanism. When a country like Russia or China or Saudi Arabia or India runs a trade surplus, meaning it sells more goods and commodities to the world than it buys, it accumulates foreign currency, primarily US dollars. Those dollars do not sit in a vault in Moscow or Beijing. They're invested in dollar-denominated assets, primarily US Treasury bonds, held in accounts within the US financial system or in Western financial institutions. The country believes it owns those assets, it has legal title to them, they appear on its balance sheet. But what February 28th of 2022 demonstrated with terrifying clarity is that ownership of dollar-denominated reserves is fundamentally conditional. It is contingent on the continued approval of the United States government. And the moment Washington decides your government has behaved in a way that is unacceptable, that ownership becomes theoretical rather than actual, the asset is still legally yours on paper. You simply cannot touch it, move it, spend it, or use it in any way. It has been turned off. The same way you turn off a light switch. Every central bank governor on earth understood immediately what this meant. It did not matter whether they agreed with the sanctions against Russia. It did not matter whether they considered themselves American allies. What mattered was the principle that had just been established in broad daylight. dollar reserves held by any sovereign nation that ever found itself on the wrong side of Washington's foreign policy. Preferences could be neutralized at will. And here's the uncomfortable question that every single one of those central bank governors asked themselves privately that morning, a question that changed the trajectory of global gold demand. If it can happen to Russia today, under what circumstances might it happen to us tomorrow? That question, multiplied across the finance ministries of over 100 sovereign nations, is the entire explanation for what has happened to gold since that day. Everything else is a footnote. Now let's talk about numbers, because numbers do not have opinions. They do not have geopolitical preferences, and they do not care about your feelings about gold or the dollar or anything else. Numbers simply tell you what is true. And right now, the numbers are telling a story that is so loud and so clear that the only reason most ordinary investors cannot hear it is because they are not listening to the right sources. So let me give you the data, and I want you to pay very close attention, because this is where the thesis becomes mathematically undeniable. Before February 2022, the world's central banks were purchasing gold at a rate of approximately 17 tons per month. That was the baseline, the historical norm, the rate at which sovereign institutions were choosing to accumulate the metal over and above their dollar and euro and yen denominated holdings. 17 tons per month. That number has been transformed. Since 2022, the monthly central bank purchasing rate has risen to approximately 60 tons per month, and it has stayed at that elevated level consistently for nearly 4 years. To be precise about the mathematics here, we are talking about a 253% increase in the rate of sovereign gold accumulation, sustained not for a quarter, not for a year, but for 4 consecutive years, and showing absolutely no sign of reversal. Goldman Sachs, not exactly a fringe institution, has confirmed this data. This is not speculation. This is documented, reported institutional behavior on a historic scale. Now, let us identify who specifically is doing the buying, because the composition of this buyer pool tells you everything you need to know about the ideological and strategic motivation behind this trade. The People's Bank of China has been on an uninterrupted gold buying spree for at least 18 months. Officially, China reports holding approximately 10% of its reserves in gold. But here's what makes that number deeply misleading. We know from transaction volume analysis that approximately 57% of all central bank gold purchases last year were unreported. Central banks are not required to disclose these purchases. They simply buy, and analysts detect the purchasing through unusual volume patterns in the physical market. The leading candidate for the world's largest unreported buyer is China. China is converting the dollars it earns from its enormous trade surplus, the dollars that flow in when the world buys Chinese iPhones, electric vehicles, solar panels, and manufactured goods of every description, and it is using those dollars to buy physical gold, quietly, consistently, and at scale. Then there is Poland, which I find to be one of the most instructive case studies in this entire story, precisely because of who is saying what. Poland's central bank governor has publicly cited national security as the primary justification for his institution's aggressive gold accumulation program. I want you to understand the significance of that language. Central bank governors are financial officials. They speak in the measured technical language of monetary policy. They talk about reserve diversification, portfolio optimization, and risk-adjusted returns. They do not, as a rule, invoke national security. The fact that Poland's central bank governor is using the language of a military strategist to justify a financial decision tells you that we have crossed a threshold. We are no longer in the realm of normal reserve management. We are in the realm of financial sovereignty and national defense. Poland sits on the eastern border of Europe, directly adjacent to the conflict in Ukraine. Its leadership has watched the consequences of the 2022 reserve freeze unfold in real time, up close and personal. They understand viscerally what frozen reserves look like, and they have made their conclusion clear through their purchasing behavior. And then there is Saudi Arabia, which matters more than almost any other actor in this story because of what Saudi Arabia's behavior represents symbolically and structurally. In 1971, after President Nixon severed the dollar's link to gold, the United States negotiated a historic arrangement with Saudi Arabia. Saudi Arabia would price its oil exclusively in US dollars, ensuring that any nation on earth that needed to buy energy would first need to acquire dollars, creating a permanent structural global demand for the American currency. In exchange, the United States would provide Saudi Arabia with military protection and security guarantees. That arrangement, the petrodollar system, has been the foundational architecture of American financial hegemony for over 50 years. It is the reason the dollar is the world's reserve currency. It is the reason the United States can run persistent deficits without the consequences that would destroy any other economy. And Switzerland's commodity analysts have now documented that Saudi Arabia has imported approximately 160 tons of gold in recent years, with volumes consistent with central bank accumulation rather than commercial use. The nation that built the petrodollar, the country whose decision to price oil in dollars gave Washington its extraordinary monetary privilege, is quietly, without announcement or fanfare, converting its dollars into gold. If that does not get your attention, I do not know what will. Beyond these major players, 22 central banks reported net gold purchases last year. Ghana, Brazil, Kazakhstan, Indonesia, India. The list runs across virtually every continent and every level of economic development. Net buying is now the rule among sovereign institutions. Net selling is the exception. This is a coordinated global reorientation of reserve strategy, and it is happening right now. I want to talk to you now about supply, because the demand story I just described only becomes fully terrifying when you understand the supply reality on the other side of the equation. And the supply reality is this: there is a fixed, finite, and functionally non-expandable amount of gold available on this planet. And the rate at which it can be extracted from the earth is a fraction of the rate at which sovereigns are now attempting to acquire it. Here's the inventory picture. The total above ground gold stock, every bar, every coin, every piece of jewelry, every industrial application, every reserve holding on the entire planet is worth approximately $29 trillion at current prices. Of that $29 trillion, approximately 20% sits in central bank vaults. The remainder is distributed across private investment holdings, jewelry, and industrial applications. Mining operations around the world produce approximately $0.5 trillion worth of new gold per year. That is the entire annual addition to the global above-ground stock. $500 billion in a world where central banks alone and are now absorbing gold at a rate that consumes essentially all of that new supply. Think about what I just said. Think about it very carefully, because this is where mathematics becomes not just compelling, but mathematically coercive in its logic. Central banks are buying at a rate that absorbs virtually the entirety of new annual mining production. That means the gold available to every other category of buyer, private investors, institutional funds, jewelry markets, industrial users, is coming from existing above ground stock, not from new production. There is no factory anywhere on earth that can be retooled to produce more gold. There is no government that can pass legislation creating additional gold reserves. There is no central bank that can print gold the way they print dollars. There is no rate decision, no quantitative easing program, no monetary policy instrument of any kind that adds a single ounce of gold to the global supply. The planet contains exactly as much accessible gold today as it will contain in 10 years, in 20 years, in any time horizon that is relevant to your investment life. Meanwhile, 95% of the world's central banks have told the World Gold Council that they intend to continue purchasing gold in 2026, and not a single one has indicated plans to reduce its holdings. You do not need a PhD in economics to understand what happens to the price of any asset when structurally constrained supply meets accelerating institutionally committed demand. The direction of travel here is not ambiguous. Now, I want to address the investor behavior I find most frustrating. most financially destructive, and most entirely avoidable, because in my experience, the greatest enemy of building wealth is not market volatility or economic uncertainty or geopolitical instability. The greatest enemy of wealth is the predictable, recurring, absolutely inexcusable mistakes that ordinary investors make when confronted with exactly this kind of opportunity. And right now, there are three specific mistakes that are costing people money, and I'm going to name them clearly because you deserve clarity, not comfort. The first mistake is the bubble narrative. The idea that because gold has risen significantly from its 2022 levels, you have missed the opportunity, and the only move left is a crash back to earth. I hear this constantly, and it reveals a profound ignorance of how major bull markets in gold actually behave historically. Let me give you a single data point that should permanently restructure your thinking on this. During the gold bull market of the 1970s, which ultimately produced a total gain of approximately 2,300% from trough to peak, gold experienced a correction of 50% in the middle of that rally. 50%. If you were holding gold and it dropped 50%, and you did not understand the structural nature of the bull market you were in, you would have sold. You would have booked your losses, declared gold a failed investment, and walked away. Right in the middle of one of the greatest commodity rallies in modern financial history. The investors who understood the underlying driver of that rally held through the correction and captured the full 2,300% move. The investors who panicked sold and missed it. Gold has recently pulled back approximately 16% from its peak. In the context of the structural demand shift I have described, that is not a warning sign. It is a normal consolidation within a bull market that has central bank demand, supply constraints, and de-dollarization as its engine. The question you should be asking is not whether you missed the rally. The question is whether the structural conditions driving the rally have changed. They have not. The second mistake is the all-in mentality. And this one is particularly dangerous because it often comes from people who have correctly understood the thesis, but have then made the classic error of confusing being right about a direction with knowing precisely how and when that direction will express itself in price. Gold is not a straight line investment. It is volatile. It will test your conviction repeatedly and aggressively. If gold represents your entire portfolio, or even a majority of it, then a 50% correction, which history tells us is entirely possible within a larger bull market, is potentially catastrophic to your financial life. The appropriate allocation for most investors, and I want to be specific here because specificity is what separates useful advice from platitudes, is somewhere in the range of 10% to 15% of your total portfolio. You can go higher if your overall financial situation provides you with the liquidity and stability to absorb volatility without being forced to sell at the wrong time. But the principle is this: your gold allocation should be sized such that you can watch it drop 50% without it materially damaging your life or forcing a panic sale. If your position is so large that a 50% correction would genuinely hurt you, your position is too large. Size it correctly. Discipline in position sizing is not cowardice. It is the mathematical prerequisite for staying in the game long enough to win. The third mistake is the conflation of paper gold with physical gold. And this error is particularly consequential because these are not the same asset. They have different risk profiles, different purposes, different counterparty risks, and different relationships to the structural thesis we have been discussing. Paper gold in the form of ETFs and futures contracts gives you exposure to the price of gold without giving you ownership of physical gold. It is a financial instrument. It trades on exchanges. It is liquid and convenient, but it is a claim, not the metal itself. Physical gold, London good delivery bars sitting in a vault you control or have. Direct legal claim to is the asset itself. Central banks do not buy GLD. They buy physical bars and they put them in their own national vaults. The Europeans are currently repatriating gold from New York storage back to their home vaults. These institutions understand something that most retail investors do not. In a genuine systemic stress scenario, the precise scenario that gold is meant to protect you against, the reliability of a paper claim on gold becomes exactly as uncertain as every other paper claim in the system. Physical gold is insurance. Paper gold is a trade. Know which one you are doing and why, because they serve fundamentally different purposes. So now let us talk about what you should actually do, because everything I've said up to this point is intellectually useless if it does not translate into a specific executable framework for action. The first decision you need to make is what purpose gold is serving in your portfolio. If you are a trader who wants to capture momentum in a rising gold market with the intention of exiting when conditions change, then gold ETFs are an entirely appropriate instrument. They are liquid, they track the price accurately, and they allow you to enter and exit positions with precision and efficiency. There's no shame in that approach if it matches your actual investment behavior and time horizon. But if you are buying gold as genuine insurance against dollar debasement, against inflation, against the kind of systemic monetary instability that the de-dollarization trend represents, then you need physical metal. Buy it from reputable, established dealers. Your AI tools can identify the leading dealers in your specific jurisdiction. Buy the largest denomination pieces you can afford, because the premium over spot price decreases as the size of the piece increases. Store it properly with appropriate insurance coverage. And here is a critical mental shift I want you to make. Stop measuring your gold in dollar terms. Measure it in ounces. The dollar value of your gold is a reflection of what? Dollars are worth relative to gold. If you are holding gold as insurance against the dollar losing purchasing power, then measuring your gold in dollars is precisely the wrong metric. You own a quantity of ounces. That quantity is your actual position. The third instrument in this category is gold mining companies, and I would encourage you to think about miners as a distinct asset class with a distinct risk-return profile rather than simply as a proxy for gold. Mining companies are leveraged plays on the gold price because their fixed costs, meaning the cost of extracting the gold from the ground, remain relatively constant while their revenue moves directly with the gold price. When gold rises 20%, a miner with a break-even cost of $1,500 per ounce and a selling price that moves from $2,500 to $3,000 sees its profit margin expand dramatically. This leverage can produce returns that significantly exceed the gold price movement itself in a rising market, but that leverage cuts both ways. In a falling gold market, miners can decline much faster than the metal itself, and they carry operational risks, geopolitical risks related to their mining jurisdictions, and management risks that physical gold simply does not. I personally maintain positions in both physical gold and selected mining companies because they serve complementary roles. The physical metal is the bedrock insurance position. The miners are the growth vehicle. Combining them gives you both the stability floor and the upside leverage that this particular moment in monetary history makes available. On timing, I want to be unambiguous. I do not know the precise date at which gold will make its next major move higher. I do not know whether we will see a further 10% consolidation before the next leg up, or whether we are already at the beginning of that next leg. Nobody knows that. And anyone who tells you they do is selling you something. What I do know with a high degree of conviction is that the structural conditions, sovereign demand running at 4 times, historical norms, supply constrained by the physical limits of what the earth can produce, a global monetary system in transition away from pure dollar hegemony, and 95% of central banks committed to continued gold accumulation are not short-term cyclical factors. They are multi-year, potentially multi-decade structural realities. In that environment, trying to time the perfect entry point is less important than making the decision to have appropriate exposure. Dollar cost averaging, buying a fixed dollar amount of gold at regular intervals regardless of the current price. removes the psychological agony of timing decisions and ensures that you accumulate more ounces when prices are lower and fewer when prices are higher. It is not glamorous. It is not intellectually exciting. It is, however, mathematically sound and behaviorally sustainable, which means it actually works. Let me close by saying something to you directly, and I want you to hear it, not as a sales pitch and not as fear-mongering, but as the honest assessment of someone who has studied financial history for a very long time. The world is not ending, but it is rotating. We are moving deliberately and irreversibly from a global monetary system built on pure dollar hegemony to something more complicated, more multipolar, and more uncertain. The dollar will remain significant. It will not disappear from the international stage, but its role will be smaller than it was, and the assets that have historically served as the alternative to a dollar dependency, primarily physical gold, will play a larger role than they have in decades. That rotation is not a theory. It is visible in the purchasing data of central banks from Beijing to Warsaw to Riyadh. It is visible in the repatriation of gold from New York to European national vaults. It is visible in the language central bank governors are now using, language borrowed not from monetary economics, but from national security. The question I'm asking you right now is very simple. February 28, 2022 was the day the world's most sophisticated financial institutions got the memo that the rules had changed. It is now years later. Have you gotten the memo yet? Because sitting in cash while the purchasing power of that cash is systematically eroded by a government that can print unlimited quantities of it is not a conservative strategy. It is financial passivity dressed up as prudence. The choice in front of you is binary. You either take deliberate, informed, correctly sized action to protect and grow your wealth in the monetary environment that actually exists, or you remain exposed to a system that has already demonstrated in the most public and unambiguous way possible that it can turn off your assets whenever it chooses. Do your research. Come to your own conclusions. Size your position correctly. Buy physical where your purpose is insurance. Use miners where your purpose is leverage growth. And start now, because the central banks of the world are not waiting for you to feel comfortable. They are already buying